Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday the 11th of January 2020 and we're publishing our gold and silver weekly update for the week ending the 10th of January. Gold rose $10 last week from $1,552 to $1,562, having hit a high of $1,611 and a low of $1,540. In sterling terms, gold finished the week at £1,195. That's up £10. And in euros, it closed at €1,404. That's up €14. Silver rose 5 cents from $18.05 to $18.10, having hit a high of $18.84 and a low of $17.84. In sterling terms, it closed at £13.85. That's up 6 pence. And in euros, it closed at 16.27 euros. That's up also 0.10 euros. The gold to silver ratio rose from 86 to 1 to 86.3 to 1. The Dow Jones closed on Friday at 28,823, down 133 points on the day, but up 189 points on the week. And it did, briefly, exceed the 29,000 level. And the NASDAQ closed at 9,178, down 24 points on the day, but up 158 points on the week. And the S&P 500 closed at 3,265, down 9 points on the day, but up 31 points on the week. Brent crude closed at $64.98, down $3.62 on the week. And WTI crude closed at $59.04, that's down $4.01 on the week. Suggesting, of course, that the fearful repercussions of Iran have abated somewhat. The dollar index stands at 97.35. That's up 0.52 for the week, despite falling on Friday slightly because of the weak and disappointing job figures. Now, we concluded last week's update with the following words. Quote, "So our view is slightly stronger gold and silver markets at the start of the week, but a trend will then soon establish itself, which could be in either direction and almost totally dependent on Iran. The end of the week, Friday, will also be critical, together with any news regarding the signing of the US-China trade deal." Well, the latter point, the US-China trade deal, there has been little announcement this past week. But gold prices did open up quite strongly, fell back again a little on Tuesday, peaked on Wednesday, fell quite substantially, pro rata, on Thursday, and staged a slight recovery on Friday. Now, of course, most of the impact last week was the strike against Iranian General Qasem Soleimani and other senior military members, and the potential repercussions that strike was likely to incur. Now, controversially, Greg and I produced 2 videos, or 3 in fact, on that subject, namely Latest News and Views with Controversially Greg, Latest News Update including Gold and Silver with Controversially Greg, and Gold and Silver Down and Latest News Discussion with Controversially Greg. The upshot of which was laying out the geopolitical tensions, plus the overall view that Greg felt the Iranians were intelligent enough to retaliate with limited force and zero or near zero loss of life. And to date, at least, he certainly appears to have been absolutely right. All this against the backdrop of every pumper and his disciple literally dominating the YouTube airwaves and our email box, believe it or not, telling us all that World War III is not only on the horizon but is fast approaching, and we'd better stock up with our gold and silver before it was too late. Ah, yes, and they also managed to add that the US dollar has also had its chips, so to speak. Interesting, though, that the dollar strengthened last week. Now, we fully accept that this may not be the end of that story. But whether one agrees with Greg or not about who was ultimately at fault here, and whether such action to take out Soleimani was wise or not, we can all argue in either direction. But despite that, one has to admit that Greg's assessment so far, in terms of conclusions and retaliation, against everything the news and talking heads were predicting, was pretty well on key and in line with events as they've panned out. And this is one of the key reasons that he is such a major contributor to our channel. Do not underestimate Greg's geopolitical experience. He is not perfect. He doesn't know everything. But he knows a lot more than most of the talking heads have experienced. Now, geopolitical issues aside for a moment, we did see gold recover a little on Friday, and ensuring the week ended in the black, or positively. The main reason for this, and as we pointed out in our update last week, Friday would be a very important day, and it certainly was. Yesterday, the non-farm payroll report was announced, together with the unemployment rate and average hourly earnings. Now, in a nutshell, the report was disappointing. In December, only 145,000 new jobs were created, against an expectation of 165,000, and in stark contrast with November's revised figure of 256,000. Average hourly earnings also fell from 0.3% to 0.1% growth. Yes, it is true that both the October figures and November figures were revised slightly downwards also, but only by 14,000 jobs between them. Again, we pointed out, when the figures were originally announced, to expect such a correction, particularly for November, as the 266,000 jobs initially declared did seem somewhat high compared to our analysis, which we admit is not perfect, but we tend to be pretty close. Now, having said that, reducing this figure, the November figure, from 266 to 256, that is just 10,000 jobs, was still more impressive than our calculations suggested, as we were expecting a 20 to 25,000 jobs reduction from that 266,000 report. The unemployment rate remained unchanged overall at 3.5%. Whilst the market was disappointed, and we saw this by the equity market response, it really was not a bad figure, especially after recent and continual gains. And we suspect that markets have perhaps not given due countenance to how good these figures actually are. Now, whatever one may think of Obama and Trump as presidents, both of them have helped to steward the US economy to many years of continual job growth. And whilst one could argue the value of such jobs and how remunerative they may be, and part-time versus full-time, nevertheless, the continual growth is still impressive. Now, it certainly comes at a cost, that is true. Increasing of the national debt, plus copious amounts of central bank financing. But so far, they have managed to keep the majority of US citizens in employment and in increasing numbers. Now, back to gold. From a technical point of view, price resistance is seen near January highs of 1611. This is typical what technical analysts do. Please note, we stated in an earlier podcast last week not to be surprised if gold attempts to extend to and reach that 1600 level, which it certainly did, but fell back again. Now, short-term support rests at the 10-day moving average of 1538. Now, this, what we're going to say, is important from a technical point of view. Weekly momentum has turned positive. Plus, the MACD histogram is printing in the black, which also points to higher prices. And the RSI and the fast stochastic also is pointing to positive momentum. Now, we still cannot rule out entirely geopolitical risk, but it does appear that the Trump administration will now use and increase sanctions against Iran and use this as opposed to military action to deal with the ongoing conflict, which again appears sensible and laudable. Now, silver moved almost in exact line with gold, but at a different rate, rising just 0.26% on the week, compared with gold's 0.63%. Now, this leads us to a very important point, or at least jogged our memory to make this very important point, which we've meant to do so for a few weeks. You will often hear on YouTube channels people stating that silver moves disproportionately percentage-wise to gold, and they use this so-called fact to argue that silver will outperform gold in a bull market, which makes it such a tremendous investment opportunity. Now, we need to be convinced that that is actually the case. It is true, at the extremes, silver moves disproportionately, that is, at the top end and at the bottom end of a bull or bear market. But generally, we see gold making most of the moves and is often the leader and silver the laggard, especially in a rising market, which is why the gold to silver ratio is so high and has, over a number of years, increased. Yes, in perhaps the end, or at the end of the last leg, we see that outperformance of a bull market. But as a consistent indicator, gold tends to react first and lead the way, especially, as already mentioned, in a positive direction. We've often noted that we've seen silver move faster downwards as a general consensus and slower and less upwards until the end of that leg, or close to the end of that leg. So please do not be fooled into thinking that if gold falls, silver is going to buck the trend and rise dramatically, or that silver will outpace gold until the near end of that run has been reached. Now, if anyone has any verifiable statistics to prove us wrong, do send them to our email address, and we'll happily address them publicly. And that's illuminatisilver@gmail.com. Anyway, back to silver prices last week. It did indeed perform well at its peak, touching the 1884 level, but then falling back quite considerably to 1810, having dipped below the $18 level. Now, traders are generally expecting silver to move quite erratically, in fact, between 1750, our preferred level for the silver price, which we mentioned many months ago, and 1850. Now, there are outliers, as we call them in our view, where silver could spike or dip, and that range is another 50 cents either way. That is between $17 and $19. Now, back in December, we pointed out that we had to see 2 weeks of New Year trading before we would proffer our price predictions for both gold and silver for 2020. And the reasons were many, in fact, but not least of which being that full trading does not resume properly until the 13th, where all traders will have returned from their holidays, with the 6th of January giving us a good guide because that's when most traders will have returned and did in fact return. Now, whilst the start of the year does not guarantee what will happen for the rest of the year, and especially in an election year, it does suggest new thinking, strategies and beliefs, untainted with traders' desires to lock in profits at the end of the previous year. And also it is important to see what the other markets, such as the equity market, is going to embrace, not only for the new year, but the start of a new decade. You see, we don't hold the negative and vitriolic views against the US establishment that the shifts of this world clearly hold, nor do we have a sensationalist book being published in order to attract buyers, and so we can be truly objective in our assessments, with no motive either way. Now, on that point, let's take a look at what economic data this coming week is likely to have an effect. On Monday, 2 bank governors, that's Fed governors, speak out, and we have the federal budget for December. On Tuesday, we have the Consumer Price Index for December, core CPI for December, and 2 more bank governors speaking. On Wednesday, Producer Price Index for December, another 2 bank governors speaking, and on Thursday, retail sales for December. Now that's important for obvious reasons, December being the Christmas period, import price index for January, and business inventories for November. And on Friday, housing starts and building permits for December, industrial production figures for December, and the consumer sentiment index for January. So all in all, a little something each day. And if you have an opportunity, do listen to the Fed governor's comments, as they will suggest, or at least follow them in the press or the media, as they will suggest the likelihood of whether they're going to remain firm and keep the dollar at current levels by not reducing rates, or capitulating and drive rates lower later in the year. Remember, when these people speak, they are professionals, and so it's the nuances one has to take account of. Now, this coming week will be interesting, to say the least. Firstly, from a technical point of view, all signs point to a higher gold price, which will be copied or reflected by silver too, but we suspect a smaller rise. However, whilst this may happen, our own in-house analysis shows that a correction is due, and we truthfully have some difficulty now reconciling these 2 opposing positions. You see, if the Iranian situation has subsided, and it becomes clear that it has, that should remove much of the fear trade out of gold and silver prices. If the much-awaited US-China trade deal is also confirmed as happening, that is, they're now on the verge of being signed or are actually signed, that too will prove positive for equities and potentially negative for gold and silver. You see, the job figures on Friday were actually good, though markets expected better. But we would suggest that the markets may indeed come to realize this over the course of the weekend. Now, we shall have full volume trading on Monday onwards, plus during the course of the week, as mentioned, have the opportunity to listen to a number of Fed governors, plus receive economic data, which will either support a growing US economy or a declining one. So next week, whilst technically we should see higher prices, geopolitically they should or could be lowered, and so this conflict exists. So on that note, which is a rare occasion, we're sitting on our hands and doing nothing either way at this stage. What we would point out, however, is that we are still of the view that this year, 2020, both gold and silver prices have more upside potential than downside risk. But equities too have the potential to enable the Dow to touch that all too important utopian 30,000 level, providing, of course, President Trump adopts measures to ensure this happens. So, we shall produce our gold and silver forecast week commencing the 20th of January. But meanwhile, do listen out for further discussions we have with controversially Greg on geopolitical issues, and for further bulletins from us on financial and gold and silver influences. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel. and press the bell sign so that you're notified of videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.